As we look at plan participants and the risks that they face as they're saving toward retirement, what are some of the risks that they should be concerned about?
Well, there's all sorts of risks. The market risk is probably the one that coming off of 2008 is the one that's in the front of the minds of a lot of folks. I mean, I think the typical 2010 target retirement date fund lost 25%. And again, these are people that are supposed to be retiring in a year or 2 years after that period. So I think market risk is on the minds of a lot of folks right now, and just how aggressive target retirement date funds should be as you approach your target retirement date. You can control that through the old-fashioned equity versus fixed allocation, or you can also control it through broadening diversification to other asset classes that are perhaps less frequently used within glide paths.
Okay. And what are some of those additional asset classes? How can you bring volatility down for participants?
I think one of the huge advantages of a custom target retirement date fund glide path is that you can incorporate stable value as an asset class. In off-the-shelf mutual funds, if you're looking at that cash type short duration fixed income allocation, it's you're typically stuck in a money market type of vehicle. But in a target retirement date fund, you can incorporate stable value, which has a nice little gimmick that allows you to get a short to intermediate duration bond fund type of return with very low volatility or no volatility theoretically. So having that ability to incorporate cash or incorporate that stable value instead of a money market type of vehicle or bond fund within the target date fund can help mitigate some volatility and give you a little bit of a free lunch within a glide path. But some of the additional asset classes that we really emphasize, TIPS, Treasury Inflation Protected Securities, they're one of the few assets that you would expect, at least over a holding period, if you have unanticipated inflation, give you a fighting chance to keep up with inflation. Other asset classes like commodity futures might be an asset class you're not comfortable offering a commodity fund in the core lineup, but within a 5 to 10% type of allocation within a target retirement date fund can really help protect against unanticipated inflation. Certain other asset classes like real estate investment trusts, or even we've even had clients use a very unusual asset class called MLPs, Master Limited Partnerships, which are energy pipeline type of funds that you can use that actually provide a very nice inflation hedge as well.
Okay, so very broad asset diversification can bring volatility down. You also talked a little bit about the glide path and making it more conservative potentially as you approach retirement. We know that there's been a real discussion in Washington on the to versus through. What's your philosophy?
Well, that's a huge challenge because in an ideal world, participants would start at age 21 at a company, stay there for 44 years, retire at age 65, and then leave their money in the 401k plan until they're 85, and they would just take a withdrawal right out. And then you could easily just say, well, obviously it should be through retirement. And then you would build a glide path that gets more and more conservative as you enter retirement and go through retirement. The reality, though, is when you look at the typical 401k plan, and it varies significantly from plan sponsor to plan sponsor, but a lot of participants, when they retire, they roll their money out of the plan. So this idea of building a glide path with the assumption that it's through retirement all the way to 85, 90, and death, ultimately. Mortality.
Yeah. Okay.
The idea of building a glide path all the way for that, I think, is a little unrealistic. So there, in my opinion, there needs to be almost a blending of the objectives. One is that you can provide, based on the current framework we have now for target retirement date funds, there needs to be this idea that for participants that do leave their money there, it provides them a through return stream. But there has to be that expectation that a lot of those assets are going to flow out, which would argue for potentially even a little bit more of a conservative approach. As we go along and certain additional innovations come into the marketplace, whether it's guaranteed minimum withdrawal products or annuities within retirement 401k plans or defined contribution plans, then some of that problem might eventually go away. But right now it is a big challenge.
And so you would argue that as the glide path approaches retirement date, a person may be 65 years of age, that it should be generally more conservative than some that are out there. What might that look like in terms of equity to fixed type mix?
Well, I think part of it has to do with if you're looking at your plan. If you're looking at a specific plan sponsor, you have to know certain things about the plan sponsor. Number one, what is the typical savings rate for participants within that plan? How long do they stay there? What's the demographic? Is there a defined benefit plan? What kind of company is it? Is it a more sophisticated group with sizable asset balances, or is it a group where this is maybe their core retirement nest egg is the defined contribution plan? So there are some of those factors that you have to consider when building the custom glide path. But I think on average, the typical target retirement date fund is far too aggressive. When we build our custom glide paths, we actually built in a constraint in our 65th, or when a participant hits 65, hits their retirement day, we want the so-called 100-year flood scenario to be a 10% loss, no greater than a 10% loss. And we're not talking normal distribution 100-year flood scenarios, we're talking the true tail events. Because at the end of the day, if a participant's 65 years of age and they have 25, 30 years of retirement ahead of them, you might say they should have a significant amount in equities still in retirement, but if they lose 25% the year before they're supposed to retire, you have to worry about the behavioral finance kickback on that, which is pulling the plug and moving their money into a stable value fund or something like that.
Okay. And with your approach to risk management, where might you stop the equity allocation then for a 65-year-old?
I think we have clients that typically range between 25% equity and 40% equity, right around that magic date of retirement date. Again, that could go up to 50 for some glide paths where we incorporate additional asset classes like high yield bonds and emerging markets. And the broader diversification we can get within the portfolios, typically the greater equity allocation is still there at retirement. And I think that's one of the things that's a bit different than the way we design glide paths, is they tend to be a bit more barbelled. So even our retired portfolios will have emerging markets, they'll have things like MLPs, even our conservative mixes, but they might have a significantly higher allocation to tips to kind of compensate for that.
Chris, thanks so much for joining us. So as you think about plan participants and saving for retirement, what are some of the primary risks that they should be worried about?
We see primarily 4 risks that participants face as they prepare for and enter into retirement. First is the timing of their retirement, and then the second is the volatility of the markets, primarily in the 5 years before and the 5 years after they enter retirement, which we would call the transition phase. A third risk that they face, we see, is inflation risk. So the risk that inflation will erode the purchasing power of their retirement income. And then finally, the fourth risk is really the element of longevity. The likelihood that they'll live longer than they either expected to or longer than their accumulated assets will allow them to sustain retirement income.
When you think about helping participants protect against those various risks, what would you suggest?
As we think about how to mitigate those risks on participant outcomes, I think we would look at it from 2 perspectives. One is plan sponsors could look at incorporating an insurance option or an insurance vehicle is an option in the plan. The second is they could investigate alternative strategies to help mitigate those risks. The first, from the insurance perspective, there are several options available in the market today that allow participants and the plan sponsors to mitigate, in particular, the transition risks and the longevity risks associated with retirement. There are many investment options, oriented options, that are specifically designed to mitigate inflation risk in particular, and to a certain extent some of the transition risks that we talked about earlier as well. So those are at least two perspectives that they should be thinking about.
Okay. And Chris, in working with plan sponsors, what are some of the most common risk protection approaches that are being taken today?
With respect to what actions plan sponsors are taking today, I think we would see primarily two. The first is custom target date strategies that incorporate alternative asset classes, whether they be real asset classes or TIPS or some other types of vehicles that are designed specifically around real returns or inflation protection of some kind. The second element that we see being taken up in the market today are the insured vehicles that are primarily variable annuity-like with the guaranteed lifetime withdrawal benefit wrappers around them. So of the insured vehicles, the GLWBs, as they're called, tend to be the ones that we see the most acceptance around today.
And you are seeing those types of insurance products come in to plans for accumulation, is that right?
During the accumulation phase, we do see adoption of the insurance-oriented vehicles because of the effect they have in terms of helping with the transition risk. So the volatility of the returns in the market immediately before retirement and immediately during retirement, the transition years. And then with respect to the income options, they're obviously going to provide some longevity protection that you may or may not have with the insured, with the investment-only vehicles.